Are you a business owner who wants to pay less in taxes? Well, I'm going to let you in on a little secret. The more you know about taxes, the less you pay in taxes. But the problem is, accounting and taxes are so effing confusing, right? But here's the thing, guys. You can do hard things, and I can help you. In today's video, we're going to be getting into depreciation, just all up in it, getting into the nitty-gritty and breaking it down. Now, before you roll your eyes and swipe past this video, let me tell you a little something about depreciation. It can save you tons on taxes. And if you're looking to pay Uncle Sam less, then this video is for you. Hey guys, welcome back to my channel. My name is Danae Wolf, and I'm a financial clarity coach, profit strategist, and virtual CFO, which means that I help ambitious entrepreneurs like you increase your profits and decrease your stress through financial literacy. Now, today I've got a great video for you, but I do have to warn you, this piece of financial education can be a doozy, but stick with me here because it could save you thousands. And if you want more videos like this, more information on all things small business accounting and taxes, please subscribe to my channel and hit the bell to get notifications. So, what exactly is depreciation? Well, depreciation is the process of deducting the cost of a business asset over its expected useful life. So instead of expensing an asset all at once, you essentially space out the expense over the life of the asset. Okay, so let's just take a quick time out here to make sure that you guys know what an asset is. An asset is something tangible that your business purchases with the expectation that it will provide a future benefit, such as generating revenue or reducing expenses. Now, I know this can get confusing, so let's talk about a real life scenario. Let's say that you own a restaurant and you purchase a $50,000 oven. This oven will, of course, be considered an asset because you purchased it with the expectation that it will generate revenue since you'll be using it to cook the food that you sell. Now, let's say that you expect the oven to work properly for 5 years, aka your expected useful life of this asset is 5 years. Now you're going to take the price of the oven, $50,000, and divide it by its useful life, 5. The answer is $10,000. This means that for the next 5 years, you can take a deduction on your taxes of $10,000 for a depreciation expense. Now, I can already hear some of you saying $10,000 is not enough. I just spent $50,000. Why can't I take the entire $50,000 deduction at once? Here's what I want you to know. There's all sorts of exceptions to the deduction tax ruling, such as bonus depreciation and Section 179, and those will give you the option to deduct more, if not all, of the cost of your asset all at once. But it might not be the best decision for you. And I'm going to share my screen in a second to show you why, because I think a visual will really help you understand better. But before I do, I just want to throw it out there, hashtag disclaimer. I am not your CPA or your tax professional. So this video is not to be considered tax advice. This video is for entertainment purposes only. So now let me explain why you might not want to take the depreciation of your asset all in one lump sum. Remember, depreciation gives you a tax deduction. And I think where a lot of people get confused is they believe that tax deductions are dollar for dollar tax savings. But that's not how this works, guys. If you purchase a $50,000 oven, you do not reduce your tax bill by 50 grand. Instead, you have to take the expense and multiply it by your tax rate, and the answer is your actual tax savings. And the tax rate is exactly why I want you to really consider not using Section 179 or bonus depreciation as a method to maximize your deduction. Because if your business is actually growing, which, let's be serious, we're all in this entrepreneurial game to grow, then your tax bracket will actually go up each year. And if your tax bracket goes up, then your depreciation expense will go up. Now, I know this can be confusing, so let's dive into this resource. It's a depreciation chart from my program, Profit Perfect Academy, your one-stop shop to all things entrepreneurial accounting. So if you're interested in leveling up your financial education, I'll link it below, and hopefully I'll see you inside of the academy soon. So you guys can see here, I've got the cost of the asset set in as $50,000, and then I've got the useful life set at 5 years. And then what I did in order to demonstrate this idea that hopefully your business will grow over the next 5 years, I laid out your business profits going up each and every year. And what I did was showed you 2 examples. The first is if you were to use that Section 179 or bonus depreciation, and you were to take this tax deduction all in one lump sum in year 1 of your business. Well, in year 1, in theory, you've got a lower tax rate. So if we do that at the 12% rate, your total tax savings turns out to be $1,200. Now, if we use the straight line method of depreciation, that means we're going to take the $50,000 and we're going to equally deduct it at $10,000 per year for the next 5 years. You can see in this scenario, we end up with a total tax savings of $12,500. Okay, now if you do not think that your business is going to grow, if you think that where you are now is where you are going to be profit-wise 5 years from now, then you might want to consider trying to expense the entire asset at once. But if you are in a growing phase, if you are in a scaling phase, I strongly urge you to consider not taking the asset expense all at once and instead going with the straight line method for depreciation. Okay, so the last thing I want to talk to you about is using depreciation when it comes to real estate, because many of you will not need to buy an oven or some type of big piece of an equipment for your business, but most entrepreneurs could probably benefit from buying a property. So let's talk about how this would work specifically when it comes to real estate. So let's say you purchase a property for $270,000. Now, when it comes to real estate, Uncle Sam says that the useful life is 27.5 years. So if you remember, our depreciation equation is set to the cost divided by the useful life equals the number you get to depreciate each year. So in this example, we'd have 270,000 divided by 27.5 equals a $10,000 tax deduction every year for the next 27 and a half years. So let's say that your business's profit, your income is $100,000 and you purchase this property and now you've got this $10,000 deduction. So you're only going to be taxed on $90,000 because your depreciation expense reduces your taxable income. Well, now let's say you purchase 10 properties. Do you see how this depreciation thing could really help you out? I'm sure you guys have heard it on the news. It's a lot of talk about the wealthy not paying taxes, right? Well, depreciation, particularly in real estate, this is a huge part of their strategy. Think about it. You purchase the property and hopefully you can rent it out so that now the tenant is the one actually paying off your mortgage, paying off your debt. But you're also receiving cash in from their monthly rents and maybe even turning a profit there. But then you get to write off the depreciation. I mean, guys, this can really be a beautiful thing and something that I strongly suggest that you look into if you are an entrepreneur who is ready to be more tax savvy and be really strategic with the money that you pay to Uncle Sam. Now, I hope you guys enjoyed this video. If it was helpful, please like and subscribe and hit the bell. And I'd love it if you guys could share this video with any of your entrepreneurial friends that you think could really benefit. Now, if you have any questions about this video, you can always find me over on Instagram at The Chic CFO. Shoot me a DM. I'd love to chat.